Another bank ended up going belly up this week, and the Fed still raised rates by 25 basis points and kept their estimates the same for the end of the year, going to a 5.1 federal funds rate. Who would have guessed it? Oh, right, that's me. This all started on Sunday, where UBS Group decided to buy out Credit Suisse for $3.25 billion. This started with a $1 billion offer, then it went to $2 billion, and finally UBS ended up settling for $3.25 billion, whereas the Friday before this, Credit Suisse was trading for $7 billion, so RIP shareholders. And the Swiss National Bank ended up backing them up with $108 billion worth of liquidity. They actually ended up doubling this offer from $54 billion. And then after this, Powell and Yellen came out with a statement saying that our U.S. banking system is sound and resilient. Can't count how many times I've heard that this week. They also announced that they're going to increase the U.S. liquidity swap line frequency from weekly to now daily, so other central banks can now borrow the dollar more and more often to provide liquidity for whenever they need it. Like whenever the Swiss National Bank ended up needing $108 billion in order to help bail out Credit Suisse. I'm glad that all of our money is going towards bailing out these banks that are super fraudulent, but it is what it is. On Monday, UBS credit default swaps, or protections from UBS going bankrupt, and the price of them actually ended up going up to a new decade high. And along with this, FRC, First Republic, ended up getting halted as it was down 47% on Monday alone. And this is creating speculation on which bank is going to go belly up next. And Cassandra BC, or Michael Burry over on Twitter, gave us this little nice chart to see which bank might be the next one. So you can pause it here, see which bank you want to pick out in order to short. But I think FRC, CMA, and maybe WAL could be the next few if this does continue. And then on Tuesday, Yellen actually ended up vowing to backstop deposits at these small regional banks. But it's interesting because the very next day, she switched up, and at the end of the day, she said she's not considering a broad increase in deposit insurance. And she said this while Fetcher Powell was speaking and saying the exact opposite, that they were willing to bail out these small banks. So you have a major conflict between the Treasury and the Fed in what they're saying. Nobody really knows, and this is creating a ton of uncertainty in the market. But one thing that I was certain of last week was that the Fed was going to raise by 25 basis points. They did, surprise, surprise. And they ended up keeping their guidance for the federal funds rate at the end of the year the same at 5.1%. So they're not backing off. They're not going to cut rates. But the market is arguing against them. The market is fighting the Fed at every step of the way because they are betting on a bank failure. And once we do get a bank failure, a major bank failure, then I do believe the Fed will cut rates. But the Fed is reactive instead of proactive. So once something goes catastrophically wrong, then the Fed will act and cut rates. But until then, they're not going to. They're going to keep raising rates, and they're going to keep them high until something goes wrong. But Powell and Yellen are convinced that SVB, Silicon Valley Bank, was an isolated event, and I kind of agree with them that this was a poorly managed bank that wasn't hedging their interest rate risk with swaps. But I do think that this could be more common than they're leading us on to believe, especially whenever they're saying that the banking system is strong and resilient basically every day at this point. Why do they need to continue to hone in on this if it is sound and resilient? So that was Wednesday for you. Major volatility around that. And then Thursday, you had the initial jobless claims coming in at 191,000 versus 197,000 the week before. And then Thursday, you had the initial jobless claims coming in at 191,000 versus 197,000 expected, down from actually 192,000 the week before. But the continuing jobless claims actually went up to 1.694 million versus 1.684 million expected, up from 1.68 million last week. Also on Thursday, you had Square getting hit with a Hindenburg report, one of the major short-selling firms and probably some of the best short-seller research that I've ever seen. They should probably replace the SEC, but good luck with that. And then the Fed added another $94 billion to its balance sheet this week versus $300 billion that they added last week. So we've reversed about 5 months of quantitative tightening just within the last 2 weeks, and the Fed backstopping all these banks and providing them liquidity. Now, I don't think that this is proper quantitative easing just because this is going to backstop the banks instead of being poured into corporate bonds. But we'll have to see what the effect of this liquidity being added to the economy is going to have on inflation. And then Friday, the core durable goods coming in at 0.0%, unchanged, versus 0.2% expected and down from 0.4% at the prior reading. And then the durable goods, regular durable goods, came in at negative 1% versus positive 0.6% expected, and a slight improvement from the negative 5% that we saw in the previous report. So the durable goods order is still negative, which is inflationary because there's less goods being ordered from manufacturers, while demand is still hot right now. And the services PMI also showed signs of inflation, coming in at 53.8 versus 50.5 expected, and up from 50.1 the month before. So this was a really, really high reading that was unexpected, and this means that services inflation is likely here to stay if these services purchasing managers believe that their industry is going to be doing well. And then the manufacturing PMI had a slight improvement to 49.3, but it's still below 50, which is negative, versus 47 expected and up from 47.3 prior. So this is a small improvement, but an improvement nonetheless, and this could mean that our supply chains could be improving in the near future. And then Fed Bullard spoke on Friday calling for 5.625 federal funds rate by the end of the year. The most hawkish member of the Fed is calling for 5.625%. Now, I think that we probably need to go to 6. We need to get the federal funds rate above the inflation rate, but right now with all of this banking mess that we're experiencing, I don't think that we're going to get there. For earnings this week, I was watching two stocks, Nike and then Chewy. Nike ended up falling 0.1% after reporting 0.79 earnings per share versus 54 cents expected, and the revenue ended up coming in at $12.39 billion versus $11.46 billion expected. They had shrinking inventories, and whenever inventories are going down, that means that Nike can raise their prices and increase their margins. And then for Chewy, they ended up falling by 12.3% this week, even after a double beat where they had 5-cent earnings per share versus 1 cent expected, and the revenue came in at $2.71 billion versus $2.65 billion. And the reason why they sold off was because they're experiencing less customers due to softening discretionary demand. So less people are spending money on buying dog toys, which means that Chewy is in the dump right now. So that's what happened this week. Let's see what's coming up next week. On Monday, we have Fed Jefferson coming in and speaking at 5 p.m., and there's nothing else going on Monday. So probably going to be very little volatility on Monday. But on Tuesday, you have retail inventories coming in at 8:30 in the morning, which came in at 0.1% positive before, and the consumer confidence coming out at 10 a.m., where the expectations is 101 versus 102.9 the month before. And then finally, you have Fed Chair for Supervision Barr testifying at 10 a.m., so it'll be interesting what they have to say after the failure of supervision for SVB. And they're definitely going to get grilled on both Tuesday and Wednesday at 10 a.m. And then on Thursday, you have Q4 GDP coming in at 8:30 in the morning, expected at positive 2.7% versus 3.4% in Q3. And the jobless claims is expected to come in at 196,000 expected versus 191,000 the week before. So a slight uptick in unemployment is expected this week. And then Yellen is speaking again. They need to give this lady a break, but she's speaking at 3:45 p.m. And then finally, the Fed balance sheet is going to be updated. Yet again, probably going to be higher. More liquidity going into the banking system. And then on Friday, you have PCE coming in at 8:30. The core PCE year over year is expected at 4.7% versus 4.7% last month. And then the core month over month is expected at 0.4% versus 0.7% the month before. And then the regular PCE, the last readings were 5.4% year over year and 0.6% month over month. We also have personal income and spending coming in at the same time at 8:30, where income is expected to take up 0.3% versus 0.6% the month before. And then spending is only expected to go up 0.3% versus 1.8% the month before. So they're expecting a spending pullback this month, coming in line with people's income. And then finally, the Michigan Economic Report is coming out at 10 a.m. on Friday, where the consumer sentiment is expected at 63.4 versus 67.0 the month before. And then the inflation expectations for the next year is 3.8% versus 4.1% the month before. And then finally, for earnings this week, we're watching Lulu and we're watching Micron. Lulu is expected to do $4.25 earnings per share versus $1.96 last quarter and $3.27 a year ago, and an average earnings per share over the last 2 years of $2.01 a quarter. And then the revenue is expected to come in at $2.7 billion versus $1.86 billion a quarter ago and $2.13 billion a year ago, with an average earnings per share over the last 8 quarters of $1.67 billion. And then Micron, on the other hand, is expected to come in at negative 0.78 earnings per share versus negative 15 cents the quarter before and positive 208 a year ago versus an average of 165 earnings per share over the last 2 years. And then finally, the revenue is expected to come in at $3.74 billion versus $4.09 billion, so a sharp decline in quarter-over-quarter revenue versus $7.79 billion a year ago. And their average revenue over the last 8 quarters has been $7.1 billion. So they're almost expected to see half of the revenue that they've seen over the last couple of years. But where are these stocks going to go? Well, let's check out our price analysis. For SPY, the expected range is 387 to 405, where we've got supports at 394.17, 391 and 386.58, and resistance at 399.03 and 406. And then for Lulu this week, the expected range is 286 to 340, where they've got supports at 304.41 and 287.48. And then for resistance, you've got 326.82 and 336.75. If they end up beating their earnings at 425 earnings per share, and they beat their revenue at $270 billion, this could end up going above $320. If they beat earnings, miss revenue, I think this will stay above 310. If they miss earnings but beat revenue, I think it'll be above 305. And then finally, if they miss on both their earnings and their revenue, I think this could be going below 290. And then for Micron this week, the expected range is 56.50 to 65.50, with supports at 58.86 and 57.22, and resistance at 62.42 and 65.56. If they end up beating their negative 78 cent earnings per share and beating the $3.74 billion in revenue, I think this will go above $60. If they end up beating earnings, missing revenue, I think it'll stay above 58. If they miss earnings, beat revenue, I think it'll stay above 56. And then finally, a miss on earnings, miss on revenue would lead this stock to probably go below $55. So that's my price analysis and the stocks that I'm watching for this week. Hopefully this video was useful. If it was, show some love, leave a like. Thanks for making it all the way to the end of this video. And thank you to all my patrons, my channel members. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.